Hello, good afternoon. I hope we are all fine. All right, so we are back into the new semester, and Nehemiah here, and today we will be talking about CVP analysis, which is actually not the first topic for this semester under cost and management accounting. But I think for the intro to management accounting, we've discussed that first semester, so I wouldn't actually get time to re-explain everything again. So let's just move on to CVP analysis. So CVP analysis is actually, I think, the most easiest for this semester, but the trickiest, right? It is not difficult, but it is very tricky. All right, so now let's just dive into what CVP is. So CVP is basically cost. We actually did an intro of it last semester, and this is just a build-up. Cost, volume, profit, right? So basically, how we are what? Comparing costs of an organization to its output or its volume or its sales, right? And then to the profit. So how they influence the organization. So let's just go into the slides and then do some small explanation. We'll come back here and then continue some calculations, right? All right. So CVP is a technique to determine the effect of changes in an organization's sales volume on its costs, revenue, and profits. So it is also based on an explicit model of the relationship among three factors, which is the cost, the sales, and then the profit. So how they change as the volume of activity was also changes, right? So if if the organization produces more, how does it affect sales? How does it affect profit? How does it affect cost? Right? So that's the main reason why we are doing this topic, to understand how they influence each other. So it can also be used to analyze the effect on profits of changes in selling prices, cost, income tax rates, and organizations' product mix. So the organization product mix is a situation where the organization is producing more than one product, right? But at the same rate, let's say the organization produces banku and then soup, right? So let's say for every one bowl of banku, the organization produces two soup, right? So that will be like a mix of like 1:2 because one for banku, two for the soup. So something like that. So we will talk more about this very soon. So it also analyzes how operating decisions and marketing decisions affect profit, right? How advertisement and then operating decision as in producing more and those kind of stuff affect profit. So whether when you produce more, it will affect profit, it will increase or decrease profit, or when you do more marketing or advertising, it will increase or reduce profit. So we are going to look at all those stuff. So most often this part normally comes in exams, the assumptions of CVP analysis. So it is the same also as the limitations. So all the assumptions are also limitations. So in case you are being asked in exams, what are the limitations of CVP analysis? You can also put assumptions down and then explain it in such a way that it is a limitation. So the first assumption we have here is that total revenue is linear. So selling price per unit remain constant as sales volume varies. So meaning that as far as CVP is concerned, the selling price per unit of a particular product is same throughout. There is no discrimination. So if it is 10 cedi, it is 10 cedi throughout. We don't change it, but it is within what a relevant range, a particular period of time, right? The second, and then rich, we know that in most organizations, uh, CVP, selling price is not actually the same throughout, right? So that's why it makes it a limitation. The other one here is also the behavior of total cost in linear over the relevant range. So cost can be accurately categorized into fixed and variable cost components. So under CVP, we can they are trying to assume that we can easily categorize cost into fixed and variable costs, which is actually difficult, right? There are some costs that have some characteristics of fixed and characteristics of what variability. So with that one, we say, well, they are semi-mixed cost, right? Or they are semi-fixed cost, or they are mixed cost. right? So variable cost per unit and fixed cost will not change as sales volume varies within the relevant range. And then they also say that sales volume is the only cost driver, right? Sales volume is the only cost driver, which is not so. We also have in multi-product organization, the sales mix remain constant over the relevant range, right? Rate might not be the same. It might rate sometime instead of producing two soup, you'll be producing only one soup instead of then you rather be producing two banku instead. So it will not be the same throughout, right? That's what makes it a limitation. So in manufacturing firms, the level of inventory at the beginning and the end of the period are the same. So that's what they assume for manufacturing firms as well. So CVP analysis is used to ascertain the break-even point in unit and revenue for firms. So we'll talk about this very soon. So CVP, this is one of the uses or application of CVP, right? So if the organization want to know the point where it will be making profits, it will not be making any profits or any loss, the break-even point, it can use CVP to determine that. Then it also helps the organization, in the determination of the level of sales units and revenue to achieve a target profit. So that's it. If you've known your break-even point, basically, then you can achieve or know your target profit. Since maybe your break-even point is this particular unit, you know that when this additional unit is being produced, this is the profit I'm going to make. It's also helping what certain selling prices of product and services as well. Because since you know your profit target, then you know this is the value or this is the amount, yeah, or this is the price you have to put on your product in order to do what to attain this profit target or whatsoever. It also helps in determining the amount of revenue required to avoid losses. As in, when you know your break-even revenue, right, then you know that you have to attain this revenue in order to what, not to make loss. Then it also helps in establishing whether fixed costs expose firms to an unacceptable level of risk or not. So with this one, we are going to talk more about this at the degree of leveraging, right? So degree of leveraging, we are going to talk about that one very soon. And then with that one, we are going to understand that if we have more fixed costs in our organization, we are exposed to more risk. And then if we have less, we are not really um, being exposed. We have not really been exposed to more risk and the likes. So it also helps in performing strategic what if analysis to influence current operations and predict the future. So if you know your break-even points and you know your variable cost and your fixed cost, now you can do some what if analysis, which is what if sales increases to this, right? What is likely going to happen? What if fixed cost that increases to this or reduces to this? What is likely going to be my profit? What is likely going to be my loss and those kind of stuff? So that's the what if analysis. What if this happens? What will happen to my profit? What if this happens? What will happen to my profit? Right. So we'll talk about that very soon. So this is something. We'll not talk more about this. I'm going to summarize all this. All right. So I think this is a summary for I think for lesson. Okay, this is yeah for lesson 1 and 2. So this is for it, right? So let's actually go to this side. Right. So this is the CVP analysis and Kasangasa. So this is the calculation part. So for CVP analysis, right, we are actually going to look for break even, break even, break even point either in units or So either in units or in sales. Let me reopen the whiteboard again. It was messing up. So either in units. What is happening to the screen? All right, so we are going to look at break-even points either in units or in sales, right? So there are some simple formulas you have to put or we have to memorize, right? They are easy. So we have to first talk about everything now. So first, let's talk about selling prices, right? Oh, what is actually happening? Okay, I won't use this board again. Let me use this board. Okay, I mean, I want to share Zoom's whiteboard instead. All right, so now, when it comes to BEP, oh, so it's actually my screen. Right, then we look at selling prices because that's what we are going to look at more. I think it's actually my screen, not that. Right, so we are going to look at selling prices. No, let me pause the screen now because all right, so I think my screen is okay now. So we can look at selling prices. Which we know to be the price tax that has been placed on the goods and services, right? So selling prices are there. Then we also look at what variable costs. So variable costs are costs that actually changes. So variable, they are costs that actually changes in total. So when they are in total, they are variable costs, like they become variable. But when they are in units, they are like fixed. They don't change, they don't vary when it's in per unit. But when it's in total, they rather change, right? So we have to look at this and then now look at what we call contribution. So contribution is basically the selling price minus the variable cost. So keep that in mind. Selling price minus variable cost. So we can just say S minus V. So contribution is only selling price minus variable cost per unit, right? Selling price. So that is when it is in units. When it is in total sales minus total variable cost is going to give you contribution margin, right? So now this is it for contribution, right? So this is where we are building everything so that the rest of this session wouldn't really be difficult. Now, when we have this, we can have total contribution. Contribution. So total contribution is basically contribution. Total contribution is basically the contribution we have up here times the number of units sold, right? So it's basically S minus V into bracket times units sold, right? So contribution times units sold. That is for total contribution. Keep that in mind. Now, we can move on to contribution margin ratio. Contribution margin ratio, CMR, contribution margin ratio. Is basically the contribution that we have up here, all divided by the selling price. That is it. So it is basically contribution over selling price. Let me write it well. Contribution over selling price is going to give us contribution margin ratio. So we know contribution up here is going to be, write it well. Contribution up here is going to be selling price minus variable cost. So basically, selling price minus variable cost all over selling price is what? Contribution margin ratio. This is easy peasy. So once you know this, the rest will be very, very easy for you. Now, we are going to also need break-even point. So break-even point, we established earlier that it's a point or is a number of units that when we sell, we are not going to make profit or we are not going to make loss, right? When we sell the break-even units, we are not going to make profit or loss, right? So this is basically total fixed cost. I can also start by breaking down the formulas like that, but I mean, for me, I don't think it is worth it. Time needs to. So total fixed cost all over contribution. That is in units. If you want break-even points in units, total fixed cost over contribution. And we know contribution was given to us to be selling price and variable cost. So basically, it is also what total fixed cost all over selling price minus variable cost per unit. Simple like this. Now, this is in units. If you want it in value, so BEP in value, or let's say in sales, let's say in sales. What you are going to do is you can multiply the BEP in units, the one you calculated up there, times the number of units sold. Right? Or you can do it this way. Total fixed cost over contribution margin ratio. You get it? So if you want it in sales, you can either multiply the break-even point you had in units times the number of units sold, or you can just take total fixed cost over contribution margin ratio, where we said CMR is equal to what? Selling price minus variable cost all over variable cost. All over selling price, sorry. So simple, right? Hey, let me check up there and then see whether I didn't do, yeah, over variable, over selling price, that's it. So this is easy. Once you understand this, we can now move on to margin of safety. I'm just summarizing whatever we are going to do today. So margin of safety is basically how far we are from the break-even point, right? So basically, it is what? Actual sales minus the break-even sales. That is if you want it in sales. If you want it in units, this is in sales. If you want it in units, then it is going to be the units sold minus the break-even point in units, right? So basically, if you have, so it is also a situation where we say that it is how far the sales should drop in order to what, for us to what, reach our break-even point. So the higher the break-even and the higher the margin of safety, the more safer the organization is, and the lower the break-even, the margin of safety, the risky, it's how risky for the organization. So let's say you have a break-even point of, let's say, 200. Now, after selling, you were able to sell, let's say, 500. Now, your margin of safety, MOS, is going to be 500 minus your break-even point, which is so BEP unit, and this is sold, unit sold. Yeah, 200. Your break-even point is going to be 300, something like this. If it is in sales, you multiply it by the selling price. You can multiply the break-even point in unit by the selling price, and then you get the margin of safety. You can, if you want a margin of safety in sales, you can multiply the margin of safety in unit by the selling price, and then you get it. The same way like that, or you can also subtract the actual sales value minus the break-even sales. Then you are good to go. Right. So that is it for margin of safety. So we can also have margin of safety in percentage in case you are being asked margin of safety in percentage. So MOS, margin of safety in percentage. Right. Margin of safety in percentage is basically we what doing the actual sales. Remember, it is what the new the actual distance actual sales minus the break even BEP sales, right? Because you want it in percentage, you divide it by actual sales. Then multiply it by 100. That's all. That's all. Right. So now we move on to the degree of leveraging, right? So degree of leveraging is not that difficult, right? What it's actually preach is that it tells how profit is going to increase when sales also increase by a particular percentage. So when it's solved for the degree of, so DOL, right? When you solve it and then you get any figure, let's say 6, and then they tell you that sales has also increased by 6%, you multiply by the 6, and then it is going to give you what? 36. So it means this is how sales and profit is also going to increase. Profit is also going to increase by what? 36%. That's what the degree of leverage is normally used for, right? So it is given by the formula this. For the simple formula, you can actually use the total contribution margin. Total contribution margin, all divided by operating profit. Right, and then you get it. Or you can also use the total fixed cost divided by profit. Then when you get the final answer, you add 1 to it. You do +1, right? Something like this. Right. So I think we will take a question and we'll solve, and then we'll get all this. So basically, as I said earlier, the degree of leveraging is just trying to tell you how much fixed cost is actually also in the organization. If the fixed costs are too high, the organization is more risky as compared to the one that is having a lesser fixed cost, right? And then if the organization's is also closer to break even, then the organization is what? Having a higher degree of leveraging, right? Because um, its break-even point is low. But if the organization is having a higher break-even point, then its degree of leveraging is actually not high. So it's less risky, right? So this is actually the summary of break-even point. So this is just a summary of it. Whatever we are going to do in the break-even distance, this is a summary of it. So let's quickly take some questions. This semester, I will not be talking plenty with the slides. I'll just come and summarize, and then we take a question and then we solve and then we move on. Right. So let's take a question. I think there are some questions in the slide as well. Let's take it and then solve. All right. So this is the first question here. First question is, Kami Boutique, owned by Minaye, can purchase dresses for 32 Ghana cedi per dress from a local factory. Other variable costs amount to 10 cedis per dress. Assume that the average selling price per dress is 70 and the total fixed cost amount to 84,000. Suppose in managing Kami's boutique, Minaye anticipates selling 3,200 dresses. She is considering what? An advertising campaign that would cost 10,000. It's anticipated that the advertising will increase sales to 4,000 dresses should Minaye advertise. So basically, what we are just trying to do here is we are just trying to help Minaye take decision based on this advertising thing. So we are just going to look for the profit before advertisement and then after advertisement. So if we find out that before advertisement, the profit is higher than after advertisement, we will not advise Minaye to what? Take the decision of advertising. But if we find out that the profit after advertising is rather higher than the profit before advertisement, then we tell Minaye, Charlie, your advert, na ebefa. Ha. So let's take this and then dive in. So now, according to this, what we are going to look at here is we have fixed cost and then variable cost here. So variable cost here is 32 and then 10 as we have here. Selling price is what we are having here at 70. And then we are also having a fixed cost of what? 84, right? Remember, whenever there is an expense that actually varies with uh, the units, right? Then it's what? A variable cost. So since this is 32 per dress, it's a variable cost. And they are telling us the other variable cost also amount to 10 cedi per dress, right? So here, quickly, we can bring out our contribution. So contribution is equal to what? 70, which is the selling price, right? Minus into bracket. We have two variable costs. We have 32 and then we have 10. So in this, the selling price minus variable cost. Right, so we have 70 minus 42 in total here. We are going to get 28. So 28 is what? Our contribution. So with this, we can find our break-even, right? So break-even point So with this, our break-even point, as we know, is what? Total fixed cost all of our contribution. Right, and the contribution is what? Selling price minus variable cost. So total fixed cost here was 84,000. We calculated for the contribution to be 28. So now our break-even point is going to be, where's my calculator? So we are getting 3,000 here. Remember, this is in units, so 3,000 units. All right, that's our BEP in units. So we can multiply this by the selling price and get BEP in what? In value. Then we are getting 210,000. All right, that's 210,000. So that is it. Or we can also use the total fixed cost over the contribution margin ratio. Now let's go and find our contribution margin in the question income. So contribution margin here is going to be the contribution, which was 28, all over what? The selling price. And you are going to 28 divided by 70. Twenty-eight divided by 70, and we get 0.4. So that is 0.4. So 0.4 so 84,000 over 0.4, which is going to give us 84,000 divided by answer. The same thing, 210,000. So you see, that's the two ways you can do that. Now that's just at the break even. Now they're asking us that suppose in managing Kami's boutique, Menaye anticipates selling 320 dresses, right? Now he can sell 220 dresses. So we can do it this way and then find the profit. So profit, you know, profit is normally what? Sales minus what? Expenses, right? So the sales is going to be what? 3,200 units. We have two ways, right? But let's use this one because it's more healthier. So profit times sales, the selling price, the unit that is supposed to be, so times the contribution, 28, all minus fixed cost, which is 84,000. Right. So this is the profit we are going to arrive at. I think the calculator is taking my time, so let me really punch it here. So we are getting 5,000. We are getting 5,600 here. Now, this is the profit before advertisement. So before advertisement, we are getting 5,600. Now let's see profit after advertisement. So profit after advertisement, are we anticipating to sell what? 4,000 units. We're anticipating to sell 4,000 units. So now it is what's going to be 4,000 times the same contribution, which is 28, minus. Now the fixed cost has become 84,000 plus the 10,000 advertisement, right? And now here's how it is going to be 4,000 times 28, 112 minus 94,000. Right. So Redes, will you advise her to advertise? Because before advert, Ankade is the profit she's going to make. Now after when she advertise, she's going to make this profit after taking everything. So she's going to make this profit. So what do? We advise her to do what? To do the advertisement. Ebefa. What you say. So that is it for this side. Now let's go to the next part. So there is another question here. right? So this the same question, right? Kami boutique owner and whatever was assume that the average selling price is the same and total fixed cost amount to 84,000. Suppose in managing Kami's boutique, Menaye anticipates selling 30,200 dresses instead of advertising. Now she wants to what? Reduce the price. So when she reduces price, she anticipates that this will increase sales to. So this is the what if analysis. This is what that this is the sensitivity analysis. It will increase sales to 4,500 dresses. Should Menaya decrease the selling price per dress to 50 to 61, right? So now we've solved for she maintaining the distance already, and then we had 55,600 cedis. We had 5,600 cedis here. Right now, let's decrease the price and then see. Remember, so decreasing price. Remember that when we are decreasing price, then it means that our contribution is going to be affected. Our contribution is going to change. Initially, it was 70, so the contribution was what? Was 28. Now it has been reduced to 9. So our contribution will also be reduced by 9. So let's look at it here. So now new contribution. The contribution is going to be equal to the new price, which is 61, minus the same thing, 32 plus 10, because it's still having the same cost, variable cost. So now we are going to get 19. So now we are going to get 19 as our contribution. So now let's look at it. Now the profit after price reduction is going to be like this. So when reduce price, we are going to sell 4,500 dresses times the contribution, which is what? 19. Or we'll be then we'll subtract our 84,000, which is our fixed cost. Right. So with this one, what are we getting? 45,000, 4,500 times 19 minus 8, 4. Let's see, 1,500. If it were be you, how will you feel? How will you feel? Will you tell Menaya to do what? To reduce price, or at least to maintain the oil needle? Because see, reducing price has brought a profit down to 1,500, whilst Anka maintaining Keke Krano would have kept profit at what? 5,600. So I want to advise her to what? To reduce price. You get it? Even though it will increase sales, but I want to advise her to reduce price. All right, not sales, selling in like the amount of thing that will be sold. All right, so that is it for that side. Now, this is the next question here. So now the same question with the same preamble, with the same everything. Now here, what they are saying is that assume that from after the first one, assume that Kami Boutique can sell 4,000 dresses, right? At the present time, the boutique cannot handle more than 3,500 dresses. To satisfy a demand for 4,000 dresses, Naya must acquire an additional capital for 6,000. Should the additional space be acquired? So we have to do the same analysis again. But here, we have two different things, right? He can handle 3,500, right? So let's check the profit at 3,500 and the profit at what? 4,000 dresses. That's what we are coming to do now. So profit at 3,500. So you see that at that side, we are not what acquiring any additional this thing, right? Any additional fixed asset or manipulating price or whatsoever. So it is going to be our contribution. Here, mind you that we are still maintaining the old contribution, the same 70 selling price, and then 32 and 31 as the variable cost. So we are still going to have our same contribution to be 28. So here we are going to get 3,500 times 28, right, minus our fixed cost, 84,000, which is going to give us 14,000. Right, it is going to give us 14,000. Let me add. All right. So 14,000 is going to be our profit if we don't acquire the additional space. Now let's look at after acquiring the additional space. So when we acquire the additional space, we'll be able to sell 4,000. Right. So now this is what it is going to look like. The 4,000 times our contribution minus our fixed cost, which is now going to be 84,000 plus 6,000 because we acquire an additional fixed cost, right? So when we do this, we are going to get 4,000 times 28, 1, 1, 1, 2,000 minus 90,000. It is going to give us 22,000. It's going to give us. So if it were be you, if it were to be you, should she acquire the additional listing? Yes, because that will increase the profit to what? 22,000. So that is it for that side, right? Now, let's take the next question. So I spoke about break-even margin of safety, right? And then I said that it is how far the actual sales is from the break-even point, right? So it is the excess of budgeted or actual sales over the break-even sales. The amount by which sales can drop before losses are incurred, because when losses fall below the break-even point, when sales fall before the break-even point, we start what? Making losses, right? And then shows how far a company is operating from its break-even point. A higher margin of safety serves as a good cushion and then indicates lesser risk. I've explained this. And the degree of operating leverage I've explained that it measures how sensitive profit is to when changes there's a percentage change in what sales. So when sales changes by 10%, I said that if it changes by 10%, then when we multiply that 10% or that 10 by the degree of leverage, it means that's how profit also was going to increase, right? If it reduces, that's the same way how profit is going to reduce. So that's for the degree of leverage. Also have additional this thing measures how, okay, the greater the operating leverage, the greater the operating risk, as I said earlier. So if you have a higher operating leverage, it means that you are closer to break even, right? But when you have a lower operating leverage, then it means what you are what far away from break even. For firms with greater operating leverage, small changes in sales leads to large changes in operating profit. And if sales increases, profits increase even more, yielding higher returns. If sales decreases, however, profits decline yet more, leading to greater risk of losses, right? So there's an example. There's an example here. So, Kami's boutique, owned by Minaye, can purchase dresses of 32 per dress for a local factory. The same thing, right? Assume that the average selling price is this, total face is this. What is the margin of safety and the degree of operating? What is the margin of safety and the degree of operating leverage? So we established later on that with this same thing, right? We established that the break-even point was what? 3,000, I think so. So let's go there. So with this, we established that the break-even point was what? 3,000. Yeah, it was 3,000 units, right? And now look at it here. Now, uh, what is the margin of safety if the sales level is for 3,500? So the margin of safety is going to just be 3,500 minus the 3,000 break even. So if you want to know your margin of safety, first you calculate your break even. After calculating your break even, then you now subtract the sales that has been given to you from the break even. You subtract the break even from the sales, and then you get your margin of safety. So with this particular question, margin of safety is going to be the 3,000 calculated for the break even, right? Which is up there already, right? But it is this way, right? So 3,500, sorry, minus 3,000. We are going to get 500 as the margin of safety. Now, remember that I said DOL, which is degree of leverage, is basically what? Total contribution margin, right? Total contribution margin all over what? Operating profit. Profit, right? So let's look at it here. So DOL, so DOL, right? To use a simple one, it's what? Total contribution margin all over operating profit. Right? So total contribution margin, as I said earlier, is the contribution times what? The unit. The contribution times the unit. So here, the contribution was what? 28. Right? And the unit, so the 3,500, because that's what we are using now. And then the contribution is what? Times 28. Now, operating profit is just going to be your 500, which is the additional distance times your contribution. Let me see. So yeah, that's it. So now it is going to be this. This one is going to give us 98,000 all over 14,000. It is going to give us 7. So the degree of operating margin is what? 7. So it means that when sales increase by 10, we are going to multiply that 10 by this 7, and then that's how profit is also going to increase by 70%. You get it? So that's how it works with the degree of operating margin. So let's move to, I think, where it's actually entertaining, but I think it's confusing to most of us, right? So where the firm is producing multiple products, right? So when the firm is producing multiple products, right, what I want you to first look at is the sales mix. How many of good A is the firm producing and how many of good B is the firm producing? Sometimes they will give you the sales mix that maybe 2:1 or 3:1 or whatsoever. Sometimes you have to look at it based on the units that has been produced and use that one as the sales mix, right? So we are going to do that very soon. So with that one, I told you that you have to what? Find the what? Weighted average of the contribution margin. So basically, you first find the contribution margin for the good or the product being produced. Now you find a weighted average, which is multiplying the sales mix by the contribution that you've gotten, right, for them. So let's quickly run through and then get this question here. But remember that when it is, where is it? It says something somewhere here. It says something somewhere here. That when when we should use the weighted average contribution margin per unit, which is WACM, if it is assumed that sales mix will remain constant in units. When it is in units, you use WACM, weighted average contribution margin. We will do that very soon. And then when it is in volume or it is in sales, then we use weighted average contribution margin. So this is just the weighted average. Find the contribution margin as we know already. Contribution margin ratio as we know already, right? The contribution over the sales, right? The same thing. Then we find the weighted average of them. So we are coming to do an example very soon, and then I think it will clear everything, right? So aside this, we will solve an additional question near upon. I'll give one as an assignment, and indeed you can send it to my DM. So all the files that I'll be using for this video will be dropped to my Telegram link. I'll drop the link in the comment section, right? So I'll drop the link in the comment section. Click on it, and then you get, if you don't have this file on quantity, which I believe everyone has, if you don't have there, then you download it. All right, so this is a question we are having here. The same Kamina owned by Menaye can purchase dresses for 32 Ghana cedi per dress, as we know already. Other variable cost is 10, as we know already. Assume that the average selling price per dress is 70 and total fixed cost is what? 84,000. Assume Kami's boutique is considering selling blouses and this will not require any additional fixed cost. So if they say that it will require additional fixed cost, then we are going to increase the fixed cost. But as far as it is not going to require additional fixed cost, we don't do that. We don't add anything. So it expects to sell 3 dresses for every blouse it sells. The selling price and variable cost per blouse is 20 Ghana cedi and 8 Ghana cedi respectively. Now the selling price is 20, the variable cost is 8. What is the new break-even point for Kami's boutique for each item? So now if you want to find the break-even point for each item, first find break-even point for the total listing. Before now, you find a way, you divide them based on the sales mix. Now, remember the sales mix has been given to us in this question that is expected to sell 3 dresses for every blouse itself. So 3:1. This is the sales mix, right? So we are going to work based on the sales mix so that you get this concept easy, right? So let's go now. Now, if it were be you, this is how I do my questions. So this is how I solve my questions when it relates to sales mix. So now the name will come Pepe Kami's Boutique. So spelling your correct one for mommy. Okay. We'll find this right. Now because the sales mix, I want to do it like this: dress, blouse, and then this is the total, right? So I want to start with the sales mix here. Remember, they said what? They have to sell 3 dresses before they'll sell 1 blouse. So 3, 1, that's the sales mix. And it will give us a total distance of what? 4. So plus equal to. Right. Now, because the thing is in units, right? We have to what? Use weighted average contribution margin. Not contribution margin ratio, but contribution margin, because it is in units. The question gave it to us is the question gave the thing to us in units, right? It said break-even point. So already we are trying to find look for it in units. So now let's continue by solving what the contribution. So contribution for dress, right? Contribution for dress, the price is what, or the selling price is what, 70. Whilst the variable cost is what? 32 plus 10, which is what? 42. Right? So 42 will come here, which is going to give us 28. Now plus, for blouse, they said the selling price is what? 20, and then the variable cost is 8, which is going to give us what? 12. The total contribution for these two is going to be 28 plus 12, 40. So I just added the 2, the ones I've underlined. Right now, because we'll be using weighted average contribution margin, now let's move on to find our weighted average contribution margin, WACM. As far as you've been able to find a contribution, the weighted average contribution margin becomes easier, right? It becomes easier. So now what we are going to do is we are going to apportion the contributions based on their sales mix. So when we take the dress, they said they have to what, sell 3. We divide it by the total sales mix, which is 4, times its contribution, 28. Right? Then this is going to give us what? 21. Now, plus, we also do the same thing for this 1/4 times 8 contribution. And this is going to give us what? 483, sorry. Now, our total weighted average contribution margin is going to what? 21 plus 3, giving us 24. So now you get it. Weighted average contribution margin is what? Just the sales mix, right? The proportion of it times their contribution respectively. You get it now, right? So simple, straightforward, and level, right? Okay, so now we've been able to find the weighted average contribution margin. Now we can find a new break-even point. Remember break-even, total fixed cost of our contribution. But here it is for the mix. So it is what? Total, so break-even point in units is going to be the total fixed cost, TFC, all over what? The weighted average contribution margin. That we just solved for. So simple, right? So now let's do the total fixed cost. Because it didn't increase, so it remained the same 84,000. All over the weighted average that we are having, the total that we are having now is this, right? So 24. Simple peasy Jeezy. So now our new break-even point in unit is going to be what? 3,500. So simple, right? That's the total destined for the organization. Now, if we want to get it for each unit, we just use their sales mix and do it. So for dress, as dress is in the first thing like this, dress is going to be 3/4 times 8 break it, so times the break even. And we are going to get what? We are going to get 2625 units. Now, for the other one, it's what? 1/4 times 20,500. And with this one, we are going to get what? 875 units. So therefore, the break-even point for dress is 2,625 units. Whilst the break-even point for blouse is what? 8,700. Hey, you say 8,875 units, respectively. So that's going to be the what? Break-even point. So that they said for each. So this is for the dress. And this is for the blouse. Easy peasy. Easy peasy. And I forgot to also talk about something. When break-even points, we want to what? Introduce profits, and then therefore maybe taxation will be part. I treated that last semester. That's why I've not really spoken about it here. So it's in the last semester break-even video. I solved questions under it as well. So which I doubt said this semester, anyway, but this is actually the deal. So this is it for this question, right? This is it for this question. So this is it. This is it. So easy, straightforward like this. It's simple, right? You don't have to think plenty. Now, I can give this question to you as an assignment. You can do it and then send it to my DM. 0244724495. This is easy. Here, let me explain this and then we solve one question and close for today. So now here, they are what? Having three way. They have sunlight, lax, and then geisha. Right? Now they are planning the operation for the quarter 30th whatsoever. You never expect to sell the product for 30 to 40 per bar respectively. So that's their selling. Variable cost per unit is for 24, and 30 respectively. During the quarter, sales revenue for Sunlight was 75,000, 750,000, 600,000, and then 150,000 respectively. The total face off for the period is what? 168. So with this one, they've given it to you in sales values. So what are you going to do? What you are going to do is you are going to use the weighted average contribution margin ratio. Remember contribution margin ratio, right? The contribution over the selling price. Right? So we can do that. So first, I told you to always find the sales mix. Sales mix. So first with this one, you can do it this way. Sunlight. Then we have Lux. We have Geisha. Right? Do the sales mix. Sales mix, just use the sales values here. So I'm just going to pick 75 and cancel the rest of the 0. 60 and cancel the rest of the 0. And then 15 and cancel the rest of the 0. So this is going to give us a total sales mix. Total will be somewhere here. Total sales mix of what? 150. So with this one, if you are apportioning it, you take 75 or 150, then multiply it by 8 respective this thing. Right now, let's do contribution. Okay, so with this one, we are going to do contribution margin because we are not going to use contribution. So let's use contribution margin. Let's do the contribution margin ratio. Sorry. So CMR. Okay, let me just use this as a opportunity. Let me do the question problem because maybe you can pause the screen and then do it, and then when you are done, you send it to me. So we have 3 this thing here. We have Geisha. Hey, Geisha cry last. We have Sunlight. We have Geisha. Hey, we have Lux. Sorry. We have Geisha. So now, let's start with the sales mix. Let me put total here. So let me start with the sales mix. So sales mix. So I'm going to use what their sales values. So the first one was 750,000. So when we cancel the zeros, you can get 75. You can either break it down more, but let me just keep it this way: 75, 60, and then this will be 15. This will give us a total of 150. So looking at it here, I've cancelled this 40. I've cancelled this 40, this 40, and this 40 as well. And I've used it as the sales mix because that's they've given it to me in revenue. So now let me move forward and then let me continue. Now, instead of solving what? Contribution, what I'm going to do is I'm going to solve for contribution margin ratio, right? So contribution margin ratio, CMR. Now for Sunlight, we are going to get what? A variable cost, a contribution of 75, what is it? So the selling price is 30 for Sunlight. So 30 minus 24 all over what? 30. That is going to be the contribution margin for that one. So this was going to be the contribution margin for this, contribution margin ratio for this. Now, the next one here is going to be what? 32 minus 24 all over 32. So 32 right? And then the last one here is going to be what? 40 minus 36 all over 40. So you see that the variable costs are here. So 40 minus 36 all over 40. Now we get the contribution margin for the first one is going to be 6 divided by 30. We will get 0.2. For this. Then this one is going to be 8 divided by 32. We are going to get 0.25. And I'm about 32 minus 24. So here is going to be 4 divided by 40. And we are going to get 0.1. So with this, you are going to get a total contribution margin ratio to be 0.4 plus 0.25 plus, so 0.45, so 0.55. That is what is going to be the total contribution margin ratio. Now, because we are doing it in sales instead of units, we have to what? Find what? Our weighted average contribution margin ratio, which is now going to be, we are going to use the sales mix, right, to do it. So 75 over 150 times 0.2 for the first one. And this one, we are going to get, so this more or less like 0.2 divided by 2. So 0.1. The next one is going to be 60 over 150 times 0.25. Which is also 0.1. The next one is going to be 15 over 150 times 0.1, which is going to be 0.01. Right, so in total, we are going to get 0.21. That is in total, 0.21. This is the weighted average CMR, contribution margin ratio, right? So now, if we want to find the break-even, look at the question. The question said what? The question said that the total fixed costs are expected to be 168,000. It is assumed that Unilever will remain, well, it is assumed that Unilever sales will remain constant in sales for the 3 months, right? So during So now we are going to find the break-even point in total, right? So now it is going to be what? Total fixed cost TFC all over weighted average contribution margin ratio. So getting tired. 168,000 all over the total so 0.21. It is going to give us 168,000 divided by 800,000. So 800,000 Ghana cedi. Right. So now, if we want to find the sales for them individually, right? So each. Why don't I pen and start teaching? Each is going to be reusing the sales mix, right? So we take the first sales mix. The first mix is so 75 over 150 times 800,000. And we are going to get 400,000. Then the second one is going to be 60 over 150 times 800,000. And we are going to get 32,000. 820,000, sorry. Then the next one is going to be 15 over 150 times 800,000. And then we are going to get 80,000. So this is the individual sales mix. So this is the answer for this last question here. I would want us to take a question and so, but I'm already tired. Let me see what we can do with this question. I think, let me explain this question and then you take your time and then you solve it, right? So EAA's Kitchen cooks and sells primary 3 Ghanaian dishes. So it is more or less like the question we just solved. Etil, Kenke, and Banku, my favorite Banku, for the local food market. Charlie, if you really want me to maybe come and teach you one-on-one, you have to be preparing Banku, then I'll come. For the local market, the cuisine, hey, bro, no, has experienced significant variations in its sales output and variable cost over the past years. Its management accountant has decided to use cost volume profit analysis to evaluate the sales forecast for the coming financial year. Carefully, EA's Kitchen has provided the following data. Estimated sales is 4,000 for Etel, 6,000 for Kinky, and then 10,000 for Banku. Selling price per unit is 30, 40, 52 respectively, like that. Contribution margin ratio, remember, is what? Selling price minus variable cost all over what? Selling price is 0.6, is 0.4, 0.6, and 0.4 respectively. The initial budget for the financial year ending 30th June 2023 indicates that Yee's Kitchen expects its total fixed overhead cost to be 260,000. So first, they said we should determine how many units of Yee's dishes must be sold to break even, assuming the sales mix remains as budgeted. Right. So look at this. Now they are asking you to do this in what units? So we are what going to use the weighted average contribution margin and not the weighted average contribution margin ratio. You get it? Mm-hmm. Then the next question is calculate the margin of safety for each dish in EAA's kitchen. Right. So let's do this. Let's do this. Let me see. Um, should I do this? Let me do this. Let me do this. Let's do this because I know say a bit what, but my plan is na me the prayer. Why? Let's say na I'll try my hands on the rest. So we have EAA's kitchen. Month location and count. I mean, go didi. Uh, let me do something to my pen and come. All right. So where is the question? All right. So now, as I said earlier, for us to do this, we have to what? Put it in this way. We have ethyl, we have kinky, and we have banku. Right now, let's first define the sales mix. And the totals will be here. All right. So now this is going to be the sales mix. Because it is estimated in units, we have to do that. So 4,000, 6,000, and 10,000. But let's eliminate three zeros. So when we eliminate three zeros, to make it easy, I don't want to go deep so that I can further break them down. But let me just use 4, 6, and 10. I think I need to close this and open it again. Right, so we have 4, 6, and 10, as we can see here. Right, 4, 6, and 10. So the total is going to be 20. Right. Now, what we will need to do is to find our contribution before we will be able to get our contribution, weighted average contribution margin. So the next thing is what contribution. Remember, the question is saying that contribution margin ratio is what? 0.4, right? So basically, what it is trying to say is that contribution margin all over sales is equal to 0.4. Right. So we have sales there. You have the selling price there. So meaning that when you multiply our selling price by the 0.4, we are going to get our contribution margin, right? So it's just the same formula now. You just have to be twisting it like that. So the sales here, the selling price here is what? Selling price here is 30. So 30, right? So 30. So it is going to be 0.4 times 30 for this one. Then using the same kind of formula now, 0.6 times 40. And then the next one is going to be 0.4 times 52. Right. So now we are going to get this one to be 12 here, then 0.6. So this one 0.6 is going to be 24. And then this is, so you see, this is 4 weeks, I think 3 weeks class, and I'm summarizing and solving questions. So, why? So 24 is here. We have 0.4 times 52. 20.8. So in total, the contributions are going to be 12 plus 24 plus 20.8. And we are going to get 56.8. Now, weighted average contribution margin, because we've been able to get contribution, weighted average contribution margin. So when we take the first one, each sales makes 4 over 12. Hey, 4 over 20, sorry. Times 12. And we take the second one, 6 over 20 times 24. And we take the next one, 10 over 20 times 20.8. And this is what we are getting for each. We are getting 2.4, and we are getting 7.2, and we are getting 10.4. So in total, so class. So in total, we are going to get 20. And go for near smart. 20 now top and one new. So now our break-even point is going to be our TFC all over weighted average contribution margin, the total one, right? So the total fixed cost in the question was what? 260,000. All over the distance we are having now is 20. So it is going to be what? 130,000. Yeah, 260,000 divided by 2. So 13,000. So now this is for the total distance. Now for each unit, but the first one is going to be the sales mix for over the BEP for each. For each, right? So each sales mix, so 4/20 times the 13,000, which is going to give us 2,600. And then the next one is what? 6/20 times 13,000. And it's going to give us 3,900. And then the next one, which is what? 10/20 times the sales mix like that. And it is giving us what? 6,500. So this is the break even for each of them. This is the break even for each of them. Right? For Etel, Kinky, and then Bang, my favorite. Right? Then this is for A. The next question is saying calculate the margin of safety for each dish. Right? So the margin of safety is what? Just the break even minus the sales in units. Right. Now we have the first one to be 4,000, estimated sales units 4,000, second one is 6,000, the third one is 10,000. You just subtract their break-even points respectively, right? So margin of safety, MOS. The first one is going to be 4,000 minus the 2,600. And we are going to get what? 1,400 units. The second one, which is kinky, is going to be what? 6,000, which is 8 sales units minus the break even that we are getting for it, 3,900. And we are going to get to 2,100 units as its margin of safety. The next one is going to be 10,000 units as the estimated sales minus 8 break-even points. And we are going to get 3,500. What's our work, Neri? Working kind way, Neri? Okay, maybe. So this is going to be their margin of safety. 14,400 for the first one, 2,100 for the second one, 3,500 for the third one. Now, the next question is what? We should what? Explain 4 assumptions of this analysis made by EA's Kitchen. So we are just going to relate the assumption of CVP to this. So the assumptions are here. Take the slide, I'll send it. Then you just go to the behavior of total revenue, linear, and the likes. Same thing, then you are done. There are other questions there. I'll send it to the page, and then I think you'll be able to try your hands more on. We have another one here. And we have another one here as well. Thank you very much for your time. Consider yourself subscribing and liking this video. Have a good evening. I didn't wanted to do it short because whenever I do it short, I feel lazy to continue. So let me do it one and for a while. I've solved everything in here. I think we are good for today. Bye.